Are you a dealer creating a workplace culture your employees are proud to be part of? Applications are now open for the 2026 Automotive News Best Dealerships to Work For program. This isn't just an award, it's a chance to get real insight into what's working at your dealership and where you can improve. And we've expanded the categories this year, recognizing everything from technician experience and leadership development to AI enablement and employee retention. The registration deadline is April 17th. Find out more and apply at autonews.com.
Welcome to this weekend drive edition of Daily Drive for the second week in March 2026. I'm Kellen Walker in Las Vegas. We're breaking down some of the biggest stories in the auto industry from the past week and looking forward to what's in store in the days ahead. There have been all kinds of developments this week on the EV front. We'll talk about Honda's costly retreat as they cancel 3 EV models, the growing tally of automaker write-downs, and the new market forces that might reverse some of those trends, like if the war in Iran pushes gas prices up to $6 a gallon. Joining me today to talk about it is Michael Martinez, automotive news reporter who covers Ford and the UAW for us. My man, Mike, welcome back.
Kel, when you were out, Jake was able to do everything in one take, so, no pressure.
Here you go. And in for Larry Veliquette this week, we're joined by Lindsay Van Hully, deputy editor at Automotive News, covering the electric vehicle ecosystem. Lindsay, welcome to this madness that we call Weekend Drive.
Long-time listener, first-time co-host. Happy to be here.
All right. So, Michael, let's start with probably the biggest story of the week. Honda's canceled 3 EVs, the 0 Series SUV, the 0 Series Saloon, and the Acura RSX. They're expecting losses up to nearly $16 billion. What's your take on this, Mike?
Well, I don't think it's a stretch to say a lot of automakers got the whole EV thing wrong, but I think some automakers got it more wrong than others. And I think Honda's one of those automakers. And I don't just mean the demand curve. Seems like everybody, is a swing and a miss in terms of how many customers actually want this type of product. But I more so mean the type of EVs and the kind of platform you need to develop them at scale and to hope to make any money at them. Honda always seemed to be behind the 8 ball. They tried to catch up by partnering with GM. That led to the Prologue, which is apparently going away after just a couple years. You could probably, paint that as a disappointment. After that, they decided to pivot to the 0 Series that looked like probably something they should have done from the start, a dedicated platform that could underpin multiple models. The concepts looked really sleek and cool. Maybe that would have been something if they had started 5 years earlier or 10 years earlier. But as they said in their announcement, they needed to stop the bleeding. They didn't see any way to turn a profit in these current market conditions. It seemed like they were always playing catch up, and they ultimately realized it was a race that was too long for them to ever hope to win.
And Lindsay, this brings the industry's total EV restructuring bill to what, around $70 billion now? What does that mean for the industry?
I mean, I think Mike just touched on it, right? It really reflects the degree to which automakers really overestimated how fast this market was going to develop. And, it's everything from, write-downs of investments, losses, just basically trying to get out in front of this. And I think some of them have said, if we take all of this up front, we can sort of get it out of the way and reset and move forward. And I think that's what a lot of this really just reflects, that, they don't need as much factory capacity. They don't need as much battery capacity. Maybe some of the models that they were planning may not have as much demand. And so I think that's what we're seeing here with, canceled vehicle lines, converting some planned EV capacity to internal combustion, investing more in hybrids than in EVs. It's sort of this reflection that, they're trying to match where demand is with the capacity that they have and the investment that they have. It's interesting because, the analysts I've talked to have said, they don't expect this to be kind of a wholesale retreat from EV and battery development. There's still going to be investment. There's still work on bringing down battery costs. There's still work on affordable EV platforms. We don't know, under a new presidential administration, do, regulations shift again? There's still this discussion about, EVs are expensive. And so they're trying to find ways to bring down that price point not just the price point, but the cost that contribute to that price point. So I think it's a sign really of just this broader reset that's ongoing, and everyone sort of taking this view of, how much space and how much capacity do we really need right now.
Well, Lindsay, that's funny you bring up reset because now we saw EV registrations drop 41% in January with market share tumbling just 5% and S&P's Tom Libby called this a reset. But do you think this is a temporary adjustment or a fundamental shift?
It's interesting. I think to some degree we'll see. When I've talked to analysts about this, they've talked about at some point EV sales are going to pick up again. EV demand is going to pick up again. There's going to be growth over time in this segment. And so I think this is a reflection of just where we are right now. There's still price challenges that are out there. There's still charging challenges. The network of EV charging nationwide is still expanding. A lot of these things I think still need to be addressed before we see a lot of that really big EV development. It's hard to say what's going to happen over the long term. I think at least for the near term, this is where it's going to be, and demand is probably going to be a lot smaller without, that federal tax incentive that went away after into the fall. But long term, it seems like there's still going to be, at least there's the belief out there that there's still going to be consumers who are going to want these, and the market will shift there eventually.
Mike, what are your thoughts on that?
Isn't everything in this industry a temporary adjustment? It's so cyclical. We're riding the roller coaster. Things go up and down. Things are in vogue. They're out. I think that, to Lindsay's point, everybody's making these adjustments because of the current market conditions. But look at what we're going to talk about in a little bit, the war in Iran. If those prices last, the oil and gas prices, we could see a quick pivot back to EVs. If there's a Democrat in the White House in 2028, we could see a quick pivot back to EVs. So temporary, probably. We just don't know how long that's going to last. Is it a couple years, half a decade? What? So I'm sure the levels will fluctuate, but to Lindsay's point, at least in the near term, we may be finding that baseline right now.
All right, coming up, we'll talk about how suppliers are getting squeezed by soaring diesel prices, Ford's promise of better transparency with suppliers, and whether new EV models could actually benefit from rising gas prices. That's next on Weekend Drive.
The EV transition has been slower than many people expected, and the financial strain isn't just hitting automakers. On this week's episode of the Automotive News Shift podcast, I'm joined by Mohammed Fatouri, Director of the Engineering and Power Solutions Division at Bosch. He explains how Tier 1 suppliers are dealing with the pressure of a softer EV ramp, shifting customer demand, and policy uncertainty, and how they're adapting in real time.
From day one, you think about options and flexibility. If you are planning based on a flexibility or optionality, then you have the leverage in the future, if need be, to pivot very quickly.
I'm Molly Boygan. Join me on Shift, available this Sunday wherever you get your podcasts.
Welcome back to Weekend Drive. I'm Kellen Walker with Mike Martinez and Lindsay Van Hully. So, Mike, let's shift to suppliers. This week, we reported how diesel prices have jumped 20% because of the Iran conflict, and that's really squeezing supplier margins. There's so much pressure on the supply chain between these geopolitical tensions and just normal everyday logistics. Are we reaching a breaking point?
Yeah, Kel, there's a bunch of jobs I wouldn't want to do. And when it comes to the auto industry, I think work at a supplier is top of that list. You just look at what they're dealing with between all the abrupt cancellations in EV programs that they've spent years and billions of dollars tooling up for. You have the shift of automakers trying to bring more and more supplier work in-house. You have, faster product development times. And then obviously with this current situation with the Strait of Hormuz, you're losing a lot of not only oil that's increasing transportation costs, but also plastics materials, aluminum, liquid natural gas. There's a bunch of building blocks to vehicle parts that they're also probably not getting. You might as well just add hail and locusts to this list of things suppliers are dealing with. It's not great. And what makes it tough is that this is already a pretty low margin business, auto in general, but specifically for the suppliers. So when you talk about something that's going to raise their prices, especially for these small guys, even if it's just 1% or 2% of their overall costs, that's going to have a major impact. So, breaking point, we have to be close given everything else that's going on.
So, Lindsay, kind of piggybacking off of what Mike just said, Flavio Volpe of the Automotive Parts Manufacturers Association said transportation is typically 5 to 6% of operating costs. So, a 20% fuel increase adds about 1% to total costs. I know it doesn't sound huge, but in context, it does sound pretty significant. What are your thoughts?
Yeah, it is. And I think our colleague Greg Layson in Canada, talked about this, kind of summed it up pretty nicely. And just this idea of the just in time industry that we all work in, right? That there's very few alternatives to trucking. We don't store parts for very long. They really get moved when they're needed in the assembly plant. And so that makes rail not necessarily an option. Fuel costs are hard to get around. And so it may seem small, but when you're working in that just in time, when it's so critical that the part arrives when it's supposed to, it makes it so that it's a really hard thing to get around.
Now, Mike, I've been waiting to ask you this all day because you know how much I just love a good Ford story. Now, we had news this week that Ford is promising better transparency to suppliers. Please explain to us what the story is here.
Yeah, so Liz Dorr, relatively new chief supply chain officer at Ford within the past half decade or so, they have a yearly meeting with their top suppliers. And this year she told them they're going to be more transparent and that they're going to try to give them now 3-year windows into their product cycles, which I love to hear as somebody who needs to report out future product every year. Great job, guys. Bump it up to 5 while you're at it. That'd be great. But in all seriousness, this is a ray of hope for the suppliers after all the stuff we were just talking about. They need security. They need to know what the plans are. So, like I referenced, they're not spending a bunch of money tooling up and preparing for a model that's just going to be canceled or shelved anyway. So Ford's struggled with its supply chain relations. When Liz Dorr first came in, she revamped their whole supplier program from how it used to be to how they reward contracts now. They still struggled because obviously Ford's struggling with a lot of things in terms of recalls, in terms of what programs it is or isn't working on moving forward. So if I'm a supplier, I'm feeling pretty great coming out of this meeting. Obviously, that was the intent. So we'll see if the company can follow through on it. I imagine if this works, it's the type of perspective you're going to want to see suppliers asking for from other automakers.
And that was what I was going to ask you, Lindsay, exactly what Mike just said. Because, you used to cover GM. Do you expect other automakers to take the same route?
We've written a lot over the past couple of years just about this issue with stranded capital, right? And it's really difficult if you're a supplier and you're trying to figure out where to make investments. Do you go all in on EVs? Do you try and diversify? How do you make those investments? And it is difficult. And I think, for suppliers, there as much of that kind of window into product plans as possible, I think is going to be really important. I think to the points Mike made earlier, there's a lot of things that throw wrenches in all of that. It's like the EV demand curve that we've seen kind of flattening out. And, whether it's tariffs, whether it's unforeseen events, kind of like that fire at the aluminum plant that's affected output of some of the pickups. I do know there's a push for transparency even deeper than that too, right? And just trying to really get at how do you get visibility far enough down the supply chain so that you can see when some of these things might happen. Is there a disruption someplace that might impact production someplace else? And so this question of transparency, I think, is really interesting, both from the product planning and trying to figure out where you make that investment, and also how do you get enough visibility into tier 1, tier 2, tier 3, tier N, so that if there's a tornado someplace that you can react, you can know it early enough and react enough that you don't have this really costly downtime, which impacts both the automaker and the supplier.
All right. So here's a very interesting angle. Now, Mike, gas prices have been climbing because the obvious, the issue and situation in Iran. But we got these new affordable EVs on the way from Rivian, like the R2. Could rising gas prices actually help revive EV demand?
Sure, if it lasts long enough, I think customers would definitely take another look to see if the dollars and cents make sense for them. You mentioned the R2, it's interesting. I don't know if that will benefit from this situation, particularly because it was announced recently that Rivian's launching with the more expensive model. I know automakers typically do that, right? But R2 is pretty important to Rivian. You could argue it's a make or break moment for them. Sales of its other models are not doing well. It's losing a lot of money, and they need this R2 to be a big hit. So they have been promising a sort of lower priced $45,000 model. Found out that's not going to come maybe for another year or so, give or take. It's going to launch with a $58,000 model. So would that be the answer if gas prices are high? Rivian's a lifestyle brand, pretty much, right? Like it's for outdoorsy type people. Pretty high costs on both the pickup and the SUV these days. They're larger than I think what a lot of automakers today think they need their EVs to be. So the R2 could be an answer. I'm just not sure the early models it's going to come out with would help save customers that much money. Maybe a better option might be the Chevy Bolt 2.0, right? Our colleague John Irwin was just out test driving it. It seems like it could be a nice option, although that limited run seems like it's going to be very limited. So will Chevy be able to produce enough of them? So a lot of questions, but there are some interesting new EV offerings coming if it makes sense for you as a customer.
Well, that's what I was going to ask you, Lindsay. You are our former GM expert. Is everyone going to be buying Bolts? Does everyone want Bolts?
Chevy will tell you that there is a very loyal Bolt ownership base, and that there's this customer base that have been in these older Bolts that may want to trade up for the new one. It's at a price point, and when I've talked to dealers, they've said, we're excited about it, even being an EV, even in this market, because of its price point. Whether demand is high enough that makes that case that this is kind of the place that EVs need to be to really spur that demand. I think we'll need to see, right? It just went on sale earlier this year, so they're just now beginning to really get out there. But when we start to get sales numbers from GM, every quarter, it's going to be interesting to see what happens there. But when I've talked to dealers about it, they've pointed to that the Equinox EV really to another degree, just for those price points, because right now, without the tax credit, you might get some automaker and dealer incentives, but you still have to have the price point at a place where people can actually get into it.
And do you think with American consumers, how we have our love for big vehicles and SUVs, that the Bolt, I'm not going to say would fall on its face, but not do as well because of the size?
I don't know. I think it did really well when it was out originally. And so I think the question is going to be just, does it continue to resonate with those previous Bolt owners? And does it help bring people in, from other brands that have been looking for an EV at that price point? So I think it's going to be really interesting to see how it does, how 2.0 does.
Gotcha. Now, Lindsay, we talked to Plug CEO Jimmy Douglas this week on Daily Drive. He made the argument that predictions of a used EV price collapse are flat wrong. He says interest and prices for used EVs have only gotten stronger so far this year. What do you make of that?
I think it's going to be very interesting as more of these leased EVs return to the market. And we know the projection is going to be, this is going to be increasing over the months and years ahead as more of these leases are expiring. And so I think we'll get a better read on what actually happens in that market when more of these are out there. It is interesting when I have talked with analysts, with some dealers recently, just reporting on the potential impact from higher gas prices and what that might do. The used EV argument has come up a lot, and the idea that there are a lot of incentives right now to try and move new EVs, and they're competing against 1, 2, maybe 3-year-old versions of the same model at potentially a lower price point. And so if you're coming into it and you're looking for an EV, maybe you're a first time EV buyer, maybe a used EV at that price point's a good way to get into it. Maybe a lease might make more sense. But I think the used EV question is going to be very interesting to see what happens. The dealers I've talked to, one actually recently said he's already looking for used EVs at auctions, to try and get ahead of potentially demand shift there. Analysts have said, it's a way to potentially educate consumers, give them a more affordable way to get into an EV and try it out. So I don't know. I think it'll be a lot of it, I think, is going to be determined once more of these return to the market and we begin to see what that actually looks like. But at least the people I talk to say there's an opportunity with used EVs that we're going to begin to see this year that maybe we just haven't yet because of numbers.
Perfect. All right. Mike, Lindsay, thank you so much for joining me.
Thanks, Kel.
Thanks.
That's all for this Weekend Drive edition of Daily Drive. I'm Kellen Walker. Thanks to Automotive News executive producer Jake Neer for his help on today's podcast. You can get the latest news on Honda's EV retreat, supplier cost pressures, and everything happening in the auto industry at autonews.com. Come back on Monday for a conversation with Mohammed Fatouri, director of the Engineering and Power Solutions Division at Bosch. He talks about how Tier 1 suppliers are dealing with financial strain from a slower than expected EV transition.
The take rate of the battery electric vehicles in the market were not as expected by the industry, but this was also a trend that we had in our scenario plannings. So we had other plans based on the approaches that we had to be able to shift our product portfolio as well as our investments commensurate to the needs that we have from the market.
We'd love to hear from you. Let us know what you think of the show and the topics we covered today. Send us an email at dailydrive@autonews.com or leave us a voicemail at 313-444-2774. If you enjoyed the podcast, remember to like, leave a review, and subscribe so you never miss an episode.